Today, what $30 trillion can do. The DFA Daily to the 17th of April 2021. Hello again, it's Martin North from Digital Finance Analytics. Work Notice posts covering finance and prop news with a distinctively Australian flavour. If you count it up, at least $30 trillion has been thrown at the global economy in the last year through both QE and fiscal stimulus. And more is coming. With global GDP back in 2019 at around $87 trillion, and with GDP in China around $14 trillion and the US around $21 trillion according to the World Bank, it's no surprise then that financial markets continue to bubble higher. Let's not talk about real wages or sustainable growth. This is all artificial as the financial sector continues to receive direct and indirect life support. Market records abound and more will follow. Of course, the question is, for how long and at what point does it fall in on itself like Mascot Towers? We are in fragile times as the virus continues to mutate and vaccine strategies wobble. But as the IMF warns, a technological decoupling between the US and China and potentially Europe would cut global domestic product by an order of magnitude greater than the recent trade war. The world is such an integrated place. Helga Berger, head of the fund's China mission, said, if you stop exchanging knowledge across countries or borders, you will ultimately pay a price, and this could be a fairly high price. IMF research estimates that technological fragmentation could lead to losses of around 5% of GDP for many countries, or about 10 times the estimated costs of trade tariffs imposed by the US and China. The warning comes after the Biden administration earlier this month added 7 Chinese supercomputing firms to the list of entities that US businesses can't sell to without special permission. It was an expansion of the crackdown that began under President Donald Trump, with curbs on exports to companies like Huawei. The Biden team is still reviewing the China policies it inherited from Trump, including tariffs on more than $300 billion worth in annual imports and a partial trade deal, but has indicated that its strategy will be broadly similar. The tensions around the US-China relationships are one of the key risks that we look at, Berger says. This is a constant concern. Tariffs between the two countries subtracted from growth last year and will do so again this year, he said, estimating the global impact at about 0.4% of GDP. But things could become more difficult if we allow technological decoupling to take place between the US and China, between other countries like Europe, he said. It's so important that these two large, very important economies that are such a large part of where the global economy goes finds a way to work together. One more reason to understand that the current market optimism is balanced on a knife edge. That said, at the close on Friday in New York, the Dow Jones Industrial Average rose 0.48% to hit a new high, while the S&P 500 index climbed 0.36% and the Nasdaq Composite climbed 0.1%. For the week, the Dow booked a 1.2% gain and the S&P 500 ended 1.4% higher, marking their 4th consecutive weekly climbs, and the Nasdaq Composite closed up 1.1% for the week to mark its 3rd straight weekly advance. Morgan Stanley, the Bank of New York Mellon, and PNC Financial Services reported first quarter results that beat estimates on the top and bottom lines, but it was the latter that got the plaudits, rising more than 2%. Other regional banks were also higher, with US Bancorp leading the charge up almost 3%, as its better-than-expected quarterly earnings released on Thursday stoked optimism on Wall Street. US Bancorp has started to experience a rebound in its fee-based businesses along with the improved credit picture, which should reassure investors that the company will navigate this downturn better than nearly all of its peers and should maintain its premium valuation to the group, RBC said. Financials have been kept under pressure in recent sessions on falling yields, with analysts warning that any further deterioration in rates would likely continue to weigh on cyclicals. Further helping it lift buying momentum was a momentary pause in a climb of bond yields, which had previously been a sign of rising borrowing costs for investors and companies. The 10-year Treasury note finished at 1.571 on Friday, up on the day but nearly down 10 basis points over the week, marking its sharpest weekly drop in about 10 months. The US economic data released yesterday was strong, confirming the US economy is firmly on a recovery track, one chief investment strategist told Reuters. It would appear that the bond market is finally buying into the Fed's low-for-longer verse, which would be supportive of non-yielding gold, said Sophie Griffiths, research head for the UK and EMEA online broker Onda. However, treasuries climbed despite the better-than-expected US data. There were suggestions that foreign buying and geopolitical risk, such as the US slapping sanctions on Russia on Thursday, could have contributed to treasuries' gains and thus positioned investors for further weakness. Fed Chair Jerome Powell also reaffirmed the central bank's continued support for the economic recovery in his speech at the Economic Club of Washington on Wednesday. Powell added that a pullback on asset purchases would happen, quote, well before the Fed considers raising interest rates. Materials were lifted by an almost 9% surge in PPP Industries in the wake of its better-than-expected first-quarter results and upbeat second-quarter guidance, which was also released last Thursday. Sentiment on cyclicals were also helped by further signs of a bullish consumer following Thursday's blowout retail sales data up 10% and weekly jobless claims figures falling to a pandemic low. The University of Michigan said on Friday that its preliminary consumer sentiment index rose to a 86.5 in the first half of this month from 84.9 in March, hitting its highest level in a year. The best performers of the session on the Dow were Cisco Systems, which rose 2.27%, and meanwhile Home Depot rose 1.67% and Goldman Sachs was up 1.13%. The worst performer of the session was Boeing, which fell 1.19%. The volatility index was down 1.93% to 1625, and that's a new 52-week low. Gold, though, had its best week since December, with US inflation risks and the reintroduction of political risk hedging helping to set the yellow metal on a potential return to $1,800, maybe. Gold futures for June was up 0.53% to 1,776. Gold's resurgence this week came as US bond yields plunged amid a hike in consumer prices that reasserted the yellow metal's diminished role as a hedge against inflation. Sweeping sanctions imposed on Russia by the US on Thursday also brought gold back in the eyes of some, at least as a protection against political risk. Gold has been throttled in recent months by bond yields and the dollar that often surged on the argument that the US economic recovery from the coronavirus pandemic would exceed expectations as the Federal Reserve kept interest rates at near zero. Adding to gold's strength was a weaker dollar, which typically boosted the yellow metal. The dollar index, which pits the greenback against the euro and 5 other major currencies, weakened on Friday to 91.56 versus Thursday's 91.62. Crude oil delivery for May fell 0.54% to 63.12, and the euro-US dollar was up 0.14% to 1.1982. Digital asset exchange Coinbase, which hit the Nasdaq this week, not via an IPO or initial public offering, but instead using a DPO, a direct public offering. And initial public offerings and direct listings are two methods for a company to raise capital by listing shares on a public exchange. While many companies choose to do an initial public offering, an IPO, in which new shares are created, underwritten and sold to the public, some companies choose a direct listing in which no new shares are created and only existing outstanding shares are sold with no underwriters involved. Nasdaq gave Coin a reference price of around $250, and it was at 342 plus, having rose as much as 70% before ending day one up 30%. The market cap is currently around $85 billion, so Coin is about 60 to 7% as valuable as the traditional financial big boys like Charles Schwab, Goldman Sachs and Morgan Stanley. And here are a few stats which suggest that Coin is a real business. It's got 56 million verified users and monthly transacting users of around 6.1 million, a trading volume of $335 billion, total revenue of about $1.8 billion, and net income of around $730 to $800 million. So it's providing real products and services to millions and millions of users. Perhaps you don't have to believe in crypto or Bitcoin to believe in Coin. That said, the astronomical growth of Bitcoin may well outrun Coinbase. Many cryptocurrencies have caught fire in 2021, and some experts and analysts believe cryptos have actually replaced gold as the preferred inflationary hedge among younger investors. In fact, here's how much $1,000 invested in each of the following cryptocurrencies back in 2016 would be worth now. Ethereum would be $273,000. Bitcoin, $148,000, Litecoin, $87,000, XRP, $267,000, and Dogecoin, more than $1 million. So cryptocurrencies have left the stock market in the dust over the past 5 years, despite their extreme volatility and a boom and bust cycle in 2017 and 18. Now, I'll let you decide if this is a real investment or a speculative bet. But if they do continue, cryptos could become more valuable than the overall stock market, or they could crash and burn, who knows. It's also worth noting the Drewry World Container Index slid 0.1% or $6 this week. However, it remains 220.7% higher than a year ago. The average composite index for the container index is $5,108 per 40-foot container, which is around $3,320 higher than the 5-year average of $1,788 per container. Now, that may signal, of course, higher prices, but will it flow into higher inflation? Who knows? European stock markets traded higher on Friday, helped by strong earnings from German auto giant Daimler, as well as a rising sentiment over a global economic recovery. The euro area, of course, is still grappling with lockdowns and a third wave of COVID-19, but business activity appears to be holding up. The April Flash Purchasing Managers Index on Friday showed that things aren't looking too bad. Signs of a swift economic recovery could raise questions about when the ECB will slow its bond buying, putting recent bond markets' calms to the test. The ECB Lagarde says the Eurozone economy, though, is still on crutches. But the DAX in Germany traded 1.34% higher, climbing to a record high. The UK's FTSE gained 0.52%, reaching another 52-week high of 7,019, while the Stoxx 600 rose 0.9% to an all-time high of 442.48. Stock markets around the globe, with Europe being no exception, have climbed to record levels of late on expectations that the global vaccination program, coupled with hefty stimulus packages, especially in the US, will unleash pent-up demand. Adding to the enthusiasm on Friday has been strong corporate news in Europe, led by the auto sector. Daimler's stock rose 2.1% as the German car and truck maker reported higher vehicle purchases and solid demand in China, helped by a strong performance from its Mercedes-Benz cars, resulting in a surge in quarterly operating profit. European car registrations jumped in March, up over 63% year on year, industry data showed on Friday, as the sector recovered from the damage a year ago when coronavirus lockdowns devastated sales. EU sales, which exclude the UK, rose an even stronger 87%, and elsewhere, HelloFresh stock rose 4.8% after the meal kit delivery company announced strong first quarter preliminary results and lifted its 2021 outlook as customers cooked more at home during the pandemic. Though on the flip side, L'Oreal stock fell 1.6% despite the French cosmetics group posting a further pickup in sales in the first quarter. The luxury sector has posted strong gains of late amid expectations customers will return with a bang as the global economy reopens. In Asia, China's Shanghai Composite was up 0.81% to 3,426, as economic data released earlier in the day was mixed, with the GDP for the first quarter growing 18.3% and 0.6% year-on-year and quarter-on-quarter, respectively, in March. Both figures were lower than forecast, with economic growth soaring from a year earlier but slowing down quarter-on-quarter. Meanwhile, industrial production fell 14.1% year-over-year, but of course, those figures are from a low base, thanks to COVID last year. And there are a number of slowing trends once you get below the surface. The latest data puts China on course to grow well above its annual target of more than 6%, supporting the view that China and the US, where economists predict 6.2% growth, will both outperform other major nations this year. The recovery last year was led by strong investment in real estate and infrastructure, spurring demand for industrial goods, while overseas orders for medical goods and electronic devices fueled exports. Consumer spending had lagged, but the latest figures showed a turnaround. Retail sales growth was 6.3% in March, when calculated on a 2-year average growth basis, which removed distortions created by last year's lockdowns, up sharply from the rates seen last year. We are seeing a bit more balanced recovery in the Chinese economy, Wang Tao, chief China economist at UBS, said in an interview on Bloomberg. That early pickup in construction industry is going to give way to more household consumption, she added. Consumer spending at restaurants and sales of discretionary goods such as jewellery, alcohol and tobacco led the growth of retail sales in March. The economy was also boosted by a jump in investment from overseas. Inbound investments into China rose almost 40% to $45 billion in the first 3 months of 2021, according to data from the Ministry of Commerce, which was released on Thursday. That was the highest for the period in comparable data going back to 2002. And the Statistics Bureau said on Friday that inflation was expected to remain in a moderate range this year, and while rising commodity costs could boost domestic prices, there's no basis for prices in upstream sectors to rise significantly. The economy is far from overheating, said Bruce Pang, head of macro and strategy research at China Renaissance Securities at Hong Kong. The consumer sector doesn't have a solid basis for overheating, and I don't think the central bank will take a faster turn for monetary policy. Hong Kong's Hang Seng Index inched up 0.07%. The city's government said on Thursday that it would open its COVID-19 vaccination program to those aged between 16 and 29, with registration to commence in the following week. Japan's Nikkei 225 edged up 0.14%, even as an uptick in COVID-19 cases in the country could lead to the cancellation of the Tokyo Olympics, now less than 100 days away. Elsewhere, Greater China markets watched the first summit between Biden and Japan's Prime Minister, and a possible reference to Taiwan for the first time since 1969. Investors have so far not priced in such risk from the sudden increase in China's maritime activities near Taiwan, but the prospect of an embittered China is casting a shadow on Japanese stocks. And locally back here in Australia, our markets were up. At the close in Sydney, the S&P ASX 200 gained 0.07% to hit a new 52-week high. The S&P ASX 200 closed 0.07% higher at 7,063. The ASX 200 financials was down 0.32% to 6,226. And the real estate trusts was up 1.52% to 1,484. The local volatility index was down 2.36% to 1108. And the ASX 200 futures was up 0.4% to 7,073. Amongst the banks, ANZ was down 0.35% to 2882. CBA was up 0.09% to 87.99. NAB was down 0.45% to 26.72. And Westpac was down 0.71% to 25.32. Amongst the regionals, the Bank of Queensland was up 0.91% to 8.91. Bendigo and Adelaide Bank was down 1.25% to 10.26. And Suncorp was down 0.1% to 10.45. Macquarie Group was down 1.01% to 156.25. And AMP was down 2.46% to 1.19 and continues to raise questions about what its fundamental value is. And Afterpay Touch was up 0.7% to 127.39. CIMEC was down 1.18% to 17.64. The Aussie US dollar was down 0.19% to 77.35. The Euro Aussie dollar was up 0.42% to 1.5497. The 2-year bond was up 4.71% to 0.089. The 3-year was down 2.59% to 0.113. And the 10-year bond was up 1.76% to 1.706. The gold Aussie cross was up 0.94% to 2,296. And the Bitcoin Aussie cross was down 2.14% to 80,307. And before I go, 2 stories I just wanted to touch on. The first is that the government has extended the HomeBuilder commencement time. It's now 18 months, and it was welcomed firmly by the HIA, saying it's welcome news for the housing industry. The uptake of HomeBuilder has created a lifetime of work for traders and helped support tens of thousands of first home buyers to achieve their dream of owning a home, said HIA Managing Director Graham Wolfe. Yet members have been severely impacted by global supply constraints and labour pressures. Builders and their clients have also been juggling delays in finance approvals, planning and building approvals, and land title. The HIA has been working closely with the government since Christmas, providing on-the-ground data and up-to-date information on home sales, building activity and supply chain issues impacting the industry's capacity to deliver on the enormous success of the HomeBuilder program. Today's announcement to extend the start date by a further 12 months from the current 6 months requirement reflects the government's commitment to support builders and streamline the delivery of the more than 120,000 homes in renovations now taking advantage of the grant. The good work that HomeBuilder has done to stimulate the economy and retain jobs will be fully realised. Builders can now continue progressing the contracts they have in an orderly way. HomeBuilder had an immediate impact from the day it was announced. It has injected confidence in the housing industry for builders, trade, contractors, manufacturers, suppliers, and into the retail sector at a time when hundreds of thousands of jobs were at risk. That confidence supported, saved and retained existing jobs and created new jobs across the housing industry throughout Australia. Workers in jobs that were disappearing early last year were reinstated as the pipeline of work from sales, design and client engagement through to construction expanded. The HomeBuilder program will support those jobs into 2022 and beyond, hundreds of thousands of workers. And the latest ABS data shows that house commencements surged by 27% in the final quarter of 2020 to their highest level since March 2000, concluded Mr. Wolfe. And the disaster at Mascot Tower Towers continues, owners of apartments in the troubled Mascot Towers building have been advised it's no longer financially viable to fix the building, and their best option is to sell up. At a meeting on Thursday night, owners were told several developers were interested in buying the building with a view to demolishing it and rebuilding from scratch. Chair of the Mascot Tower Owners Corporation, Gary Dagan, told the ABC the only solution in our mind is to sell the building off. We have lost a lot of money. We have to decide whether we're going to continue to lose money or try to recover some. It is almost 2 years since residents were evacuated from the 10-story buildings, 132 apartments, after cracks were found in the basement. Since then, they have not been able to live in the building, and 9 owners of commercial premises on the ground floor have also been locked out on safety grounds. During the meeting, the Mascot Towers Owners Corporation told owners that in the event of a sale going ahead, they should expect to take a loss of between 70 and 80%. So someone who, for example, paid $1 million for their apartment would receive somewhere between $200,000 and $300,000 from the sale. Undoubtedly, there will be bankruptcies, Mr. Dagan said. But the longer we do it, the more money we lose. The Owners Corporation has been told it will cost $38 million to fix the building, which would blow out to $64 million, including interest over the course of a 15-year loan. It means a 3-bedroom unit owner will be paying $2,000 a week for 15 years, Dagan said. He said the escalating costs had left many unable to meet repayments. We can't have a situation where some owners can't pay and others are supposed to foot the bill, he said. In the event of a sale, the money will be used to pay off the $60 million debt the Owners Corporation has incurred so far in trying to fix the building. The balance would then be distributed among the owners depending on the size of their property. If you can vote yes now and get 100% over the line, we can at least get something out of the wreck, Mr. Dagan said. If we have to wait 12 or 18 months, it just means we've got millions of more dollars of costs which come out of everyone's pocket. Now, just a couple of closing thoughts. The first is that this particular example of bad quality construction is not the only example, and I wouldn't be surprised to see some other buildings also going the same way. And I'm still not convinced that the changes that the New South Wales government has brought in is really yet making a difference. There are thousands of defective properties around the place. And this is an important warning, of course, to everybody that prices of property can go down, particularly when they're defective, and go down substantially. And with regard to HomeBuilder, well, there was probably a need for some support for the construction sector, but this is overkill. We've already got too many spare properties, around 1.2 million, and we're building more. And we are, of course, using government money to support the sector, yet more debt. And standing back to where I started this conversation, the amount of stimulus flowing through the system around the world is astronomical. No surprise at all that financial markets are still high at the moment. But the question is, where do they go from here? Will they turn or will they go higher? Well, nobody knows. We'll have to watch and see. And finally, before I go, a quick reminder that on Tuesday, I'll be joined by Senator Gerard Rennick, who will be talking with me about the question of monetary policy, the role of the Reserve Bank, the national bank that we need, and a bunch of other questions too. Rennick, of course, asked some very significant questions in the recent Senate hearing to the Reserve Bank. And I want to take that conversation a bit further, so mark your diaries and join us next Tuesday at 8 p.m. Sydney time. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.